So Jason, you want to talk about so something that's been in the news, and especially as rates go up, Japan and the yen carry trade, and who actually owns the U.S. debt?
Yeah, let's stay on the debt topic just for a little bit. I mean, it's so massive; it is the elephant in the room. But I think one thing that is a misconception by most Americans is they assume that our debt, which is again is 36 trillion, is owned by the rest of the world. That they have us, they have us over a barrel, so to speak, because they have all of our debt and they could turn it in and things like that. But at the end of the day,
they can't turn it in. Let's be clear on that.
Sell it.
They can't turn it in.
Sell it or drive rates up.
Nor can we refi them. It doesn't work.
But sell it off or dump it or whatever where they're just driving rates up. But my point being is that at the end of the day, the majority of the owners of our debt is Americans. Over 20 trillion of the debt is owned by Americans through owning government bonds, pensions, things like that. But the majority of the foreign debt that is outstanding, most people assume that it's all China, because that's probably what they hear in the news and that's the headlines. But they're not the number one holder of our debt. The number one holder is actually Japan, right around 1.1 trillion. China is only about 800 billion of the 36 trillion, so it's quite a small amount.
Again, 1 trillion out of 30-ish.
36.
So it was 1.3, but it shrunk. A lot of that has to do with the movement in treasuries too. But it's around what was that number I just saw? It was around 765 billion. Correct, for China.
Yeah.
So which is only 2% of the debt. It's not
as big as people believe, I think. And so the one thing that's making the news, you may hear it on occasion. It's called the yen carry trade, and what that means in English is that for decades, Japanese bonds were trading very, very close to zero. So you could borrow money in yen, borrow it from Japan, and maybe you're only paying about 0.25%, and you immediately take that money, convert it into dollars, and then go do U.S. bonds, and you're going to make it a spread on the difference. And traders and hedge funds and investors would pull this off, I think, for the last 10 to 15 years maybe. But what's happening here recently is we're seeing, well, let me back up. That trade works if one of two things, or I think both things need to happen. The rates need to stay where they're at, where the Japanese bonds are, it's cheaper to borrow and you're investing for higher. So we get that. But it's also a currency risk, because if you need the dollar to stay strong and the yen to stay weak, because otherwise you got to turn the money back in and it could go against you. So the chart that I've got up right now, it's the two things that matter most to this right now. You've got, on the orange line, you've got the Japanese 30-year government bond interest rate, and that's going up and to the right. And then you also have the strength of the yen versus the dollar. You could say it's flat. You could say it's kind of going up and to the right, but it's not going down. And so with some of the items that we've mentioned with what's going on in the U.S., whether it's tariffs or this tax bill or debt or printing money, our dollar has weakened a little bit to the yen. And so this carry trade that we've heard about may no longer work. How that may affect our bonds.
And their interest rates gone up, relatively speaking, a lot.
Right. So, so the spread on what you would make between the two bonds, right now the Japanese 30-year bond is at 3%. Our 30-year bond is about 5%. And so our traders really going to take that much risk in the currency exchange in order to make just, 1%, maybe 2%.
Yep.
So it's somewhat news relative, but at the end of the day, even if this didn't carry on anymore and people weren't, buying U.S. bonds for this trade, the Japanese bonds as an exposure to our total debt is still a very small amount, 1 trillion of the 36. So again, it's in the news, but I wouldn't be too concerned about it.
I think the real risk is that the news part of it is that Japan's going to unwind. This yen carry trade is going to unwind. In other words, people are going to get out of all their
flood the market,
non-yen bonds, assets, and they have to pay back, in yen. But like we just pointed out, it's 2% of the.
Well, and it makes a ton of it makes for a lot of volatility when that unwind starts to happen.
Yes, correct.
Because it's not just one entity; it's massive leveraged, hedge funds and global macro funds that do this all at the same time, because it turns negative for them all at the exact same time, and so they all have to rush to the market to unwind the whole thing. And we saw that, I think it was in the fall. I can't remember exactly what month it was, but it was pretty nasty for global assets for about a week, and then it got settled down. Reminds me, years ago, there's a huge sell off, and we didn't find out for like 2 months after that. Saudi Arabia went in and raised like $40 billion and sold out equities because they just needed some cash.
Yeah.
And it's like,
trying to figure it out.
Where's all the selling coming from? And then you find out, it's one player that has just massive amount of assets in place.